Good afternoon. Welcome to MidCap Radar. I'm Reema Tendulkar. With me is Sonal Bhutra, and these are the top stories of 1:30 p.m. Midcat slipped but outperformed larger peers in a seesaw trade ahead of the budget and the US Federal Reserve meeting. Declines outnumber the advances. IT shows some resilience.
Adani Group CFO tells CNBC-TV18 he's confident of the fixed price offer of Adani Enterprises sailing through on the stated terms on the back of institutional investor interest. This even as it issues a response to Hindenburg's questions that draw sharp rebuttal from the research firm.
Data pattern leaps after a strong Q3. The management tells CNBC-TV18 they're targeting 40 to 45% revenue growth and margins of over 40% in FY23.
A whole host of mid-caps stumble on disappointing results, losing 3 to 6% intraday. Aarti Drugs reports a year-on-year decline in margins and profit, while high fuel costs weigh down Kajaria Ceramics.
Bharat Electronics and Hiranba Industries slumped 7 to 20% following their earnings. A steeper than expected decline in margins drags Bharat Electronics lower, while Hiranba Industries dives after dismal performance on all fronts.
Okay, those are the top headlines, but the biggest headline is, of course, the way market is moving today. Last couple of minutes, there was an attempt to recover from the lows, but that too has been sold into. So the Nifty is down 120 points as we speak, with the mid-cap index down 144 points, and the banks are again underperforming with cuts of 1.4%. So 570 points gone on the bank Nifty as we speak. The only sector in the green is Nifty IT, with the likes of TCS, Tech Mahindra, all of them at the day's high, but continues to be a down day yet again. Third day in a row where we are seeing massive cuts for our own markets. And Reema, we talk about pre-budget rally, but that's not in sight anywhere.
Well, even Santa Claus saluted us, that Santa Claus rally, and this time even that pre-budget rally. But this is pretty sharp, right? The cuts that we're seeing. We opened slightly higher, then there was this big decline in the markets, and then that sharp recovery. The Nifty high today was more than 17,700. So from that level, it's down about 200 points. And taking stock of the 3-day decline, Wednesday, Friday and today, the Nifty is down about 630, 640 points, while the bank Nifty is down 2,900 points. On Tuesday, the Nifty Bank had closed at levels of about 42,700, 42,800. So from there, it's now approaching a 3,000 point fall on the Nifty Bank, and that is pretty sharp. And even the recovery in Adani Group stocks, which we saw in the F&O names,
sold into.
That's been sold into, right? So it's red now as we speak for Adani Ports.
Yes, so of course that's the big story that we are tracking, and we'll keep getting updates for you as well. But it's a result season as well, so let's get to your corporate conversation. Embassy REIT is on our radar today. The company delivered a good third quarter with revenue up 17%, even as operating margin slipped a tad bit. Note that its dividend payout ratio also rose by around 2% on a year-on-year basis. To discuss this, the outlook going forward, and what is the commercial real estate pipeline really looking like, we have with us Mr. Vikash Khadolia, who's the CEO at Embassy REIT. Vikash, good afternoon. Thank you so much for joining us. In 9 months, you've already achieved 90% of the leasing targets that you had set for FY23. The target was around 5 million square feet. Will you surpass it? Are you changing your guidance? Because 9 months look really good. What kind of leasing trends are we looking at right now?
Yeah, first of all, thank you, Ekta, and good afternoon. Thank you for having me over the show. So, Q3 was another very strong quarter for us at Embassy REIT. As you mentioned, we year to date achieved about 44 lakh square feet of leasing. That's about 90% of the annual guidance. And mind you, the guidance that we laid out was significantly higher than the pre-pandemic average. So it just goes to show how strong, institutionally owned quality real estate, the demand for such real estate is in the country. And we continue to see global captives looking for space and expanding and setting up new centers in India. So we are very optimistic. We are very happy to deliver on this guidance. Even our NOI and distribution per unit is on target. And given that we have about 8.5 lakh square feet of Q4 pipeline of leases, we are hoping to deliver, above our guidance target. But we'll wait and see for the next quarter.
Any indication, Vikash, hi, this is Reema here, what the leasing target for FY23 could be? 5 million square feet, could you bring it up to 6 million, 6.5 million? And even your top line guidance of about 2,700 crore, how much could you exceed it by?
Yeah, I think we are well on target. That's what I would want to say. We would obviously review our numbers, and in Q4, it all depends upon the execution and how fast we can deliver on the discussions that we are having currently. We have about 8.5 lakh square feet of live pipeline. But the more important thing, Rima, I wanted to just highlight here is that our conviction on the India office story and the long-term advantages that it offers remains as strong as ever. While we have heard about unemployment, we have heard about volatility in the broader markets, I think that's more cyclical, but the India's cost advantage is more structural. And if you recollect, last time I mentioned that we have dual advantages, both of low cost and abundant talent. I think that is what is really placing us very well. And with the quality offering that we at Embassy REIT have in terms of the total business ecosystem, we are seeing disproportionate share of demand compared to what the overall market is seeing. We have also continued to see rental growth, especially in our core market of Bangalore. So overall, we remain very positive. We have in fact added 52 new occupiers in just the last 18 months. And despite the larger deals taking some more time to close, we have continued to see extremely strong momentum on the smaller and mid-sized deals, especially from occupiers like global banks, healthcare firms, as well as global retailers now. We have done a couple of deals with them last quarter. So all in all efforts are on to deliver a very strong full year numbers, by end of March.
Okay, Vikash, this is Sonal here, not Ekta. But I just wanted to understand, since you are talking about growth or at least demand coming in from global captives, but we are in a scenario where we are talking about layoffs in global tech companies. There was also a reason where we saw Blackstone and Starwood real estate funds limiting withdrawals because of rising rates. There were some withdrawals and redemptions that investors asked for. Are these global factors not impacting Indian demand at all? And when you talk about rental hikes as well in the Bengaluru market, how much of a hike have you seen? Is it something that will continue as well?
Sure, Sunil. Thank you for that. So a couple of things. One, India office is very different from what we see globally, right? And, we've spent a lot of effort to kind of go and reach out to the institutional investors globally, most of whom understand the India office story, and it is India office has continued to be very, very resilient compared to what we have seen globally. The rents in India, just to give you an example, are about $1 to $2 a foot a month. That is, significantly lower than what you would see in some of the top key cities globally. Again, the labor cost in India, the cost of a technical IT tech professional is about 1/10 of what you would see globally. So the cost advantage which India has means that a long-term structurally, there'll be more and more work that will be offshore to India. We've seen that trend in the past. We've seen that trend post the global financial crisis, and we continue to see the trend today. So one is that India office is placed very well and is very different from what we see globally. Two, while we are watching the global events, we are watching and mindful of the macro concerns, but we continue to see momentum on the ground and on our conversations. We continue to see a good uptick on the back to office numbers. We've seen a 30% increase in our own portfolio in terms of the physical attendance, and corporate leaders have been very clear that office is a place for collaboration, and hence we think as people come back to work, even more and more numbers, we will see more and more demand, especially for our kind of properties which are focused towards employee wellness and ESG. So we think that India office is really placed well.
Right. Got it. Vikash, what is the current rental escalation that you have in your clauses on an average, and what could that number look like?
Yeah, so the market, it's pretty standard market of 15% every 3 years or 5% every year. Okay. So that forms the bedrock of our NOI growth, because that's contractual, that's a given. But more interestingly, Rima, the mark to market that we have, which is basically the in-place rentals, so existing contracts have rents which are below market simply because there were agreements continuing over the last 5-10 years. And that is the opportunity that every quarter, every month, when we lease out new buildings, we try and see where we can bring those rents back to market, and that gives us an enhancement in our revenue.
All right, Vikash, thank you so much for joining us and telling us what's happening as far as the Indian commercial real estate is concerned, and Embassy REIT in particular as well. That's the word coming in from Embassy REIT. For now, we'll slip into a short break. Up next, Mitesh Thakkar will join us for some technical trades. Stay tuned.
Welcome back. We are practically at the day's low once again. Pull up that intraday chart on the Nifty and you would see that after a flattish opening, there was a big decline that we saw in the markets. at around 9:15. The low today was 17,446. After that, in a matter of minutes, the markets recovered. It went to levels of 17,700, and since then, there has been a grind down in the market with excessive selling coming through just in the last 1 hour. And once again, the Nifty now below that 17,450 mark, around that level. We are pretty much again at the day's low. Let's quickly take stock of the Adani Group stocks. There you have it. Adani Enterprises, where their 20,000 crore follow-on public offer is open for public subscription. That stock is currently down. It's now back in the red. It was holding up in the green through the trading session today. From the day's high, it slipped 10%, which means at one point of time, Adani Enterprises stock was up 10%, and now it's given up all those gains and is in the red. The stock is currently trading at levels of 2,730, much below the FPO price, the floor price that they had set of 3,112 on the way down. So even if you take into account the 64 rupee retail shareholding discount which will be given, it turns out to be 3,050. That's the price retail shareholders will get it, and the stock is well below that. Even the other Adani Group stocks like Ambuja Cement, Adani Ports, these were stocks which were holding up in the green, and they too have now sold off.
Yes, and the impact can be seen on the markets as well. As you pointed out, at the day's low, the Bank Nifty has actually extended the losses that we were talking about, around 700 points lower on the Bank Nifty as well. So it's a good time to get a technical check on the markets and get some expert advice as well. We have with us Mitesh Thakkar of earningwaves.com to tell us just that. Mitesh, well, once again, we have come to the day's low, and after that tad bit of a recovery that we did see, Nifty has again broken those levels. What are you suggesting? Will we see more pain because it's been 3 continuous days of massive selling for our own markets?
So I think one, we are heading into an event, and budget would be a very important event. But having said that, the structure has been very weak. I was earlier in the day highlighting that for the last week, the Nifty had a very big red candle starting from 18,200 to as low as about 17,490. And similarly on the Bank Nifty. So I think till we break the pivots, which were the earlier consolidation lows on the upside, which was 17,800 for the Nifty, till we start going beyond that, I would be slightly negative and will maintain mild short bias. And because of the event, I think it's not aggressive short bias. But I think a good chance that we will test the 200-day average, which is around 17,300 for the Nifty. And maybe in case the budget is slightly on the negative side or mildly disappointing, then I think even levels below that. So such as week till we cross 17,800 very clearly.
Okay, week till we cross 17,800, and you see the Nifty heading towards its 200-day moving average, which is 17,290, 17,300. Mitesh, individual trading ideas, and are you seeing retail shareholders throwing in the towel? Look at the kind of fall that we're seeing in individual names as well. The Nifty Bank too is now down 700, 800 points. In a matter of 10 minutes, it sold off an incremental 200 points.
So I think the pressure is very clearly there, and for the Bank Nifty as well,
All right, so looks like we have lost that connection, but yes, as Rima was pointing out, we are losing those levels rapidly. Look at Nifty Bank, it's down 750 points right now, and across the board there is selling that has come through. So at the day's low, we have something like an Indices Bank, SBI, ONGC also is at the day's low. So this fall that we've seen in the last couple of minutes has really come in from some of these banking names and Adani stocks as well. We'll try to get that connection back, but for now, let's also look at some other stocks in the broader markets which are declining, and this is our special mid-cap spotlight segment looking at Hiranma Industries because that stock is down 20% in trade right now. It is at the lower circuit, and it has been a weak performance on a YY and on a quarter-on-quarter basis. Revenues are down 30% on a YY basis, EBITDA down 67%, margins have taken a sharp hit, 8.6%, that's a 940 basis points cut, and profits are down 76% as well. That's not only on a YY basis, in quarter-on-quarter, revenues are down 34%, EBITDA down 64%, and profits are down 73%. Company says that they saw challenges in their domestic technical demand. Demand was low due to challenging market conditions and lower inventory, with higher inventory as well. Once demand comes back, they do see that, yes, prices should go back to earlier levels. China opening up is also positive for them, and that's why they expect quarter 4 to be better in China than quarter 3 as well. Export demand is impacted due to challenging macro macroeconomic conditions and higher inflation as well. And contraction in the margins is due to high raw material prices and elevated fuel costs as well. So yes, they've cut their guidance as well. Now FY23 revenue is expected to be flat versus earlier 15 to 17% growth, and this will be led both by their volumes and pricing as well. EBITDA margins also, they look at 12 to 14% now versus 15 to 17% earlier. Weak numbers, guidance cut, definitely not working well for the company, and the stock is down 20% in trade.
There's another one, BEL, Bharat Electronics. This was a darling of the stock as investors were latching on to the defense theme, but the earnings were a miss, particularly on margins. And this is the third consecutive quarter that the order book has declined. Right? So the company is executing, so you are seeing top line growth, but clearly new orders are not coming in and filling in the pipeline. So the order book has declined for the third consecutive quarter in a row, and the stock is getting punished today, plunging close to about 7%. This is a stock which has, doubled in a matter of 2 years now. 2 years back, the stock was at 40 rupees. The high, the 52-week high, was 112. So from that level, it's off about 25%. But, today it's coming in for some amount of punishment. It's time now for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every day. We gave you the question at 9:14 a.m. today, but just in case you missed it, here is today's question. What percentage of the expenditure in budget FY23 was allocated to defense? And your options are 7%, 7.4%, 8.7%. Send us your answers on Twitter. Post your answer as a comment on the question tweet on CNBC TV18 News. Use the hashtag budget with CNBC TV18. Hurry and send us your answers. Remember, we'll announce the winner at 3 p.m. today.
Welcome back. Well, the selling pressure has only intensified. Look at the bank Nifty. When we started the show, it was down around 550 points. Right now, it's sitting with cuts of 900 points, almost at that level, and at the day's low as well. And of course, the Nifty too, in tandem with the moves that we are seeing in the bank Nifty, is down another 180 points. So sharp downtick is what we are seeing across the major indices as well. The mid-cap index also lower by 0.9%. And we were talking about Adani stocks as well and how they have fallen from the highs. So this hour itself, we are seeing sharp cuts coming in for that pocket as well. So let's do one thing. Let's go across to my colleague Nimesh. He's joining us with what's really happening here, Nimesh.
Hi, Sonal. So, intraday, if you see, and as you rightly pointed out, most of the stocks have fallen sharply. In fact, in the morning trade, all the F&O stocks were at a 10% upper circuit, and from there has been a 13 to 15% correction in most of the Adani F&O group stocks. So now the key reason for the nervousness could be the fact that if you look at the subscription details of Adani FPO, which is going to close tomorrow, there is hardly any update or any addition, so to speak. So if you look at the numbers, total there is only 2% subscription to the FPO. The QIB portion, there is hardly any subscription, so 0% in terms of QIB portion. In the NI, it's just 1%. On the retail category, there is just a 3% subscription so far, and at the employee level as well, in the employee category, the subscription is just 10%. So I guess that could be one big reason why there is a bit of nervousness in the second half, in today's trade on the Adani stock. So that could be the one big reason. And as I said earlier as well, for the next 2 days, the Adani FPO is going to be a big talking point, and that's what the market seems to be interested into. While the management came on record on CNBC TV18, and the CFO was quite confident that they will get the demand. They have confidence that the issue will go through, and hence they've not changed the date or as well as the price as well. So as things stand, the FPO ends tomorrow, which is 31st of January. The price band is 3112 to 3276. 3276 is what the anchor investor came in. So that is something to track very, very closely for the next 2 days. I believe the second half, bit of weakness in Adani Group stocks is essentially because of the fact that there has been hardly any subscription details in the Adani FPO, and that's what I guess is nervousing the street.
Okay, interesting. Thank you very much for joining in. So the Adani Enterprises FPO is going to be a key trigger for the group and even for a market point of view. People are hiding in IT names, HCL Tech and TCS. Pull up those intraday charts and you would see that even as the market is moving southwards, these stocks are seeing buying interest and now have moved to the high point of the day. Numbers coming in from Gale, the Q3 numbers, and moments ago, even Exide reported the Q3 numbers. Out of time on MidCap Radar. Thank you for watching. Your stocks when we return.